Welcome, everyone. This is Investor David Podcast, where I discuss history's greatest entrepreneurs and investors. If you like the following conversation, it would mean a lot to me if you like this video and subscribe to the channel. And now enjoy the conversation. Recently, we read the classic The Intelligent Investor by Benjamin Graham, and today we'll be discussing our thoughts on it, what stood out, what confused us, and what we're still debating. Chris, glad to have you here.
Thanks, David. Always good to dig into ideas with you. This book was a challenge, but worth every hour.
Absolutely. You can't just read this book. You have to wrestle with it. So let's start with Graham's core distinction. Investing versus speculating. He says the difference lies in the process, not the outcome. What did you take from that?
It was a gut check. Graham defines investing as something that, after thorough analysis, promises safety of principal and an adequate return. Anything outside that, speculation. And I think that redefines what most people think they're doing.
Yeah, because if you're just chasing hot stocks on Reddit or YouTube, that's not investing. It's just dressed up gambling.
Right. Even when it works, it's luck. And Graham makes it clear, if you can't explain why you bought something in terms of logic and data, you're speculating.
Let me throw a situation at you. You're handed 100 Zalozen to invest on behalf of a relative. They trust you completely. How would you apply Graham's principles?
First step, protect the downside. I'd probably do something like 50% in government or high-grade bonds and 50% in reliable dividend-paying stocks. No chasing returns, just focusing on preservation and long-term growth. And I'd rebalance once a year, slow and steady.
That sounds solid, but I'll admit I'd still feel tempted to do better, to beat the market somehow.
Sure, and that's the emotional trap Graham warns us about. He says the investor's worst enemy is likely to be himself. That line hit me.
Same, it's humbling. The real challenge isn't picking stocks, it's managing your own psychology. All right, next idea, margin of safety. This concept sounds simple, but it's actually really deep. How do you interpret it?
To me, it's like buying $1 for 70 cents. You want a cushion. So even if you're wrong, you don't get wiped out. It's risk management at the core.
But here's the issue. In a world where everything feels expensive, how do you find that margin?
You wait, and you stay disciplined. Graham was big on patience. He didn't chase trends. He looked for mispriced opportunities.
Yeah, he said the intelligent investor is a realist who sells to optimists and buys from pessimists.
That's timeless advice.
So let me ask, you find a company that looks undervalued, but its management is shady. Do you still invest?
No way. Part of the analysis is who's running the business. If management lacks integrity, the numbers don't matter. You're building on sand.
Agreed. It's like Enron. Everything looked good until it didn't. Character matters.
Yeah. Graham doesn't just teach you how to look at numbers. He teaches you how to think. And thinking means asking, what could go wrong?
Next topic, defensive vs enterprising investor. Where do you fall?
I want to say enterprising because it sounds more exciting, but I'm probably more defensive. I like systems. I like simplicity. Index funds, dividends, long-term compounding. That's my lane.
I'm in between. I read 10KS for fun, but I also know I don't have an edge.
That's honest. And Graham respects that honesty. He says most people should stick with a defensive approach.
Right. Not because they're not smart, but because it frees them from unnecessary stress. Most people don't need to beat the market. They just need to not lose to it.
Exactly. The best investors aren't always the boldest. They're the ones who survive the longest.
So let's dig into something that caught me off guard. Graham's take on market fluctuations, specifically his metaphor of Mr. Market. What did you think of that?
It was brilliant. He paints Mr. Market as this emotional partner. One day euphoric, the next depressed. And our job isn't to listen to him. It's to exploit his mood swings when they serve us.
Right. Most people get swayed by the market's mood. They panic when it's down, get greedy when it's up. But Graham's saying, treat the market like a tool, not a guide.
And here's the genius. Mr. Market doesn't care if you ignore him. He'll still show up tomorrow with a new offer. So you don't have to react every time the market moves.
Which is hard in today's world because we're bombarded by noise. Alerts, headlines, Reddit threads, they all scream do something.
Exactly. But Graham wants us to develop emotional discipline to see volatility as an opportunity, not a threat.
All right, let me push you a bit. Say a stock you believe in drops 40%. You've done the analysis. Do you buy more?
If the fundamentals haven't changed, yes, but I wouldn't rush in blindly. I'd double check my thesis. If it still holds, that drop is a gift.
But what if the drop shakes your confidence?
Then that's a me problem. And that's why Graham emphasizes margin of safety. If I bought with a cushion, the pain won't be fatal. And it'll remind me, never bet so much that one mistake can ruin you.
Well said. And it brings us to another idea, intrinsic value. Graham talks about it like it's this North Star. But let's be honest. How do we really estimate intrinsic value in a world of unpredictable events?
That's where it gets tricky. There's no perfect formula. But the point is to try to get in the ballpark. You look at earnings, assets, cash flow, and you use conservative assumptions. You aim to not overpay.
So it's less about precision, more about direction.
Exactly. You're not trying to hit a bullseye. You're trying not to shoot yourself in the foot.
Okay, here's a dilemma. Company A has steady but slow growth. Company B is flashy, fast growing, but bleeding cash. Which one do you pick?
I'd lean toward company A. Graham would say, choose the one with reliable fundamentals and a margin of safety. Company B might be exciting, but if it crashes, your capital's gone.
But don't we risk missing the next Amazon or Tesla?
Sure, but Graham's philosophy isn't about catching rockets. It's about building a fortress. It's okay to miss a few home runs if you avoid striking out.
That's tough advice in an era obsessed with 10x returns.
I know, but it's why Graham's wisdom endures. He's not selling hype. He's teaching resilience.
And that connects to temperament. He says the investor's chief problem, and even worst enemy, is likely himself. That line keeps echoing in my head.
Me too, because it's brutally honest. Our ego, fear, and impatience are the real risks, not the market.
So the solution isn't just strategy, it's self-awareness.
Right. Graham wants us to master our behavior, not just our spreadsheets, because even the best analysis crumbles under emotional pressure.
Let's pause here, because that's profound. In investing, your character matters as much as your IQ, maybe more.
Absolutely. You can be brilliant and still fail if you lack discipline. But if you're patient, humble, and grounded, you'll win in the long run.
And that's what this book is about, not quick wins, not hacks, but building a mindset that endures.
Exactly. Graham gives us a blueprint, but it's up to us to follow it day by day.
So far, we've covered Mr. Market, margin of safety, intrinsic value, and temperament. But let's move to something more tactical. Graham's concept of defensive as enterprising investors. How do you interpret that distinction?
Great question. Graham's basically saying, know who you are. If you're not willing or able to put in the work, be a defensive investor. Stick to diversified, high-quality, low-cost options.
And the enterprising investor,
That's someone willing to dig deep, analyze financial statements, monitor companies, study industries, and most importantly, have the temperament to act rationally under pressure.
So it's not just about time and effort. It's also about emotional resilience.
Exactly. Graham warns that being active without skill and discipline is dangerous because now you're exposed without the tools to handle it.
What would you say you are, Chris?
Honestly, a defensive investor with moments of curiosity. I like studying businesses, but I don't trust myself to beat the market consistently. So I lean conservative.
I respect that. And I think many people want to be enterprising, but don't realize what it demands.
Right. It's easy to underestimate the work behind investing well. And Graham keeps bringing us back to that. Successful investing is not about brilliance. It's about avoiding big mistakes.
Which brings us to speculation. Graham doesn't say never speculate. He says separate it from investing. What do you think he meant?
I think he's warning us not to fool ourselves. If you're chasing trends, timing markets, betting on hype, call it what it is. Speculation,
And if you're speculating, do it with money you can afford to lose.
exactly. Graham's advice is set aside a small portion of your portfolio for speculation if you must, but don't let it infect your core investments.
I like that word, infect, because speculation can be emotional poison. It feels exciting, but it clouds judgment.
And let's be honest, we all feel that temptation, the fear of missing out, the thrill of quick gains. But Graham says, be rational, not emotional.
Imagine this. You're holding a stock that's gone up 300% in a year. Everyone's talking about it. You feel like a genius. Do you sell?
If I can't justify the valuation anymore, yes, I'd remind myself the market owes me nothing. And the goal is not to be greedy, but to be wise.
But people say, let your winners run. How do you balance that?
I think you let winners run if fundamentals justify it. But if price and value have disconnected, it's time to reconsider. Graham would say, reassess without emotion.
And that's the tough part. Cutting through the noise, ego, and hope.
Right. That's why Graham is timeless. He's teaching us to think clearly when the world is shouting.
Let's pivot slightly. Graham talks a lot about financial statements. Book value, earnings, assets. Do you think today's markets still reward that kind of analysis?
Yes and no. Short term, not always. Markets are noisy and hype can dominate. But long term, fundamentals still matter because eventually reality reasserts itself.
So even if a stock is overpriced today, it will find its level over time.
Yes. And Graham's approach is to wait, to be okay with sitting out fads, knowing that true value wins in the long run.
Let's do a quick imaginary scenario. Say it's 2021 and you're offered early shares of a hot tech startup. No earnings, but huge growth potential. Do you take the risk?
Only with money I can afford to lose, and I treat it as speculation, not investment, because there's no margin of safety, no reliable track record. And that's not what Graham would advise for serious investing.
But would you regret not investing if it became the next Amazon?
Maybe for a minute. But then I'd remind myself, my goal isn't to win every bet. It's to survive and thrive over decades.
That's powerful because regret is real, but discipline has to be stronger.
Exactly. And that's what Graham gives us, a framework for discipline, patience, and clear thinking.
Chris, I want to talk about one of the most underrated parts of the book, the role of inflation and interest rates. Graham doesn't ignore them, and neither should we. How do you see their impact on an investor's mindset?
They're like the background music of investing. You don't always notice them consciously, but they shape everything. Inflation erodes purchasing power, and interest rates determine what kind of returns are attractive.
So if interest rates are high, even great companies have to offer higher returns to justify the risk.
Exactly. Graham would say, don't look at a stock in isolation. Compare it to the risk-free rate. What can you get from a government bond? What's the real premium you're getting?
And in an inflationary environment, even that 5% bond yield might not be enough.
Right. If inflation is running at 6%, you're losing money in real terms. Graham urges us to always think in terms of real value, not just numbers on paper.
And that ties into valuation too, doesn't it?
Yes, when rates are low, future earnings are worth more today, so people pay higher multiples. But when rates rise, those same valuations look expensive fast
And yet most retail investors ignore this.
because it's not sexy. It's not exciting to talk about the Fed funds rate. But Graham's message is understand the forces behind the price.
Let me throw in a quick imaginary one again. Say you have two choices, a stock with 10% projected return or a bond at 8% guaranteed return. Which one would Graham favor?
He'd look at the risk. If the stock is volatile and uncertain, he'd probably say, take the bond. Because safety matters, especially for the defensive investor.
So even though the stock offers more upside, the margin of safety may be in the bond.
Bingo. It's not just about return. It's about risk-adjusted return.
And risk is often invisible until it's not.
Exactly. Graham tries to make risk visible before it shows up in your portfolio.
And that brings us to another big piece, emotions. How to handle fear and greed, how to avoid self-destruction.
Yeah. Graham understood that your worst enemy is often you. He said, the investor's chief problem, and even his worst enemy, is likely to be himself.
I love that quote. It's brutally honest.
Because think about it. Markets crash, prices drop, fear spreads. What do most people do? They sell. Not because it's rational, but because it's emotional.
So Graham's solution,
Create systems, rules, ways to protect yourself from yourself.
like dollar cost averaging.
Yes, it forces you to invest regularly, no matter the mood of the market. You remove timing and emotion from the equation.
And value investing itself is a system.
Absolutely. You're buying with a margin of safety. You're staying within your circle of competence. You're ignoring the crowd. That's a system built for resilience.
But it's hard. You have to be okay looking wrong in the short term.
And that's where character comes in. Value investing isn't just an approach. It's a temperament.
And Graham knew that most people won't have the stomach for it.
Right? That's why he wrote this book, not just as a how-to, but almost as a character guide. He's shaping your mindset, not just your tactics.
I love that, because at the end of the day, you could give two people the exact same strategy, but their results will differ wildly based on how they think and behave.
That's why this book is timeless, because it speaks to the person behind the decisions.
And if you think about all the people who've read it, Buffett included, it's changed how they live, not just how they invest.
Yup. And that's the beauty of it. The intelligent investor isn't just about stocks. It's about becoming an intelligent human being.
We've gone deep into the ideas, valuation, emotion, character, inflation. But let's zoom out a bit. What do you think it means to be an intelligent investor, Chris?
For me, it's not about IQ. It's about self-awareness, discipline, the ability to stick to principles when the world around you is losing its mind. Graham wasn't just teaching you how to invest. He was teaching you how to think.
So it's mental resilience.
Exactly. You could know everything about balance sheets and still blow up your portfolio because you panicked during a crash.
Or chased a bubble.
Right. Graham's whole message is protect yourself from that. Protect your capital, protect your sanity.
And he's not saying don't take risks. He's saying take intelligent risks, ones you understand and can afford.
Yes. And always with a cushion. That's where the margin of safety comes in. It's not just a number. It's peace of mind.
And it allows you to sleep at night.
Which might be the most underrated return of all.
So let's say someone's listening right now. They're new to investing, may be intimidated by the complexity. What would you tell them?
I'd say start by understanding yourself. What are your goals? What is your risk tolerance? Don't just copy others. Build your own strategy.
And keep it simple.
Yes, Graham believed in simplicity with structure. You don't need fancy tools. You need solid thinking.
And time.
Absolutely. Compound interest is powerful, but only if you give it time, and only if you avoid big mistakes.
So really, success is about staying in the game.
Yes, longevity over brilliance. The market will test you. But if you're patient, thoughtful, and grounded, you'll survive. And if you survive long enough, you usually win.
And that reminds me, Graham said, the investor's worst enemy is likely to be himself. So this book, in a way, is a manual for defeating that enemy.
It is. And it does it with humility. He never acts like he has all the answers. He's just showing you what's worked over time.
And what's likely to keep working.
Yeah, timeless principles in a constantly changing market. That's rare. And that's why this book still matters.
It really is one of those books you keep coming back to. Not for hot tips, but for wisdom.
And clarity. When the world gets noisy, this book helps you find your signal again.
Well said. Chris, this has been such a meaningful conversation. Any final thoughts for our listeners?
Yeah. Don't rush. Learn to love the process. Investing isn't a race, it's a journey. Read slowly. Think deeply. And most of all, stay rational when it's hardest.
Beautiful. Thank you so much for joining me, Chris. This wasn't just a book discussion. This was a mindset discussion.
Thank you, David. I've enjoyed every minute. Hope everyone listening finds something they can take and apply, not just in investing, but in life.
And that's what it's all about. Thanks for tuning in, everyone. Until next time, stay thoughtful, stay patient, and stay invested.
Take care, everyone.